Welcome. Businesses are a lot like people. They might look perfectly healthy on the outside, but to really know what's going on under the hood, they need a proper checkup. And today, we're going to give you the tools to be the doctor. So, how do you actually do it? I mean, think about it. A company can have a super flashy office and its sales numbers might be huge, but that's really just the surface. To see the real story, to check its vital signs, we need a special set of tools. Let's see how they work. It really is just like a visit to the doctor. A doctor uses a stethoscope, a thermometer, right? They're measuring your vital signs. Well, a business owner does the exact same thing, but their tools measure things like profit, cash flow, and debt. These tools have a name. They're called financial ratios. And believe me, they tell you everything you need to know. So our checkup today is going to tackle 5 simple but really powerful questions. First, is it making money? Can it pay its bills today? Is it working smartly? Will it even survive tomorrow? And finally, what's it really worth? All right, first things first. The most basic question of all. Is this business actually making any money? This is what we call the profitability check. Okay, let's start with a super simple story about chocolate. Imagine you buy a chocolate bar for 10 rupees. Then you turn around and sell it for 20. That 10 rupee difference, that's your initial profit. And that's the core of what we call gross profit margin. It's the profit you make right from the product itself before any other costs even enter the picture. But of course, that's not the whole story, is it? You've still got to pay for rent, electricity, maybe you have a helper. So after all those other bills are paid, the money that's left over, that's your net profit margin. This number is the real truth teller. It's what you actually get to keep. Okay, now let's say you took 100 rupees out of your own piggy bank to get this whole thing started. At the end of the year, you made a profit of 25 rupees. This ratio, return on capital, it's basically asking one question. Is the money I put in just sitting there, or is it out there working hard for me? In this case, your money is working very, very nicely. Making a profit on paper is great, but it's totally useless if you don't have the actual cash to pay this month's rent. And that brings us to our next vital sign, the liquidity check. This is all about being able to pay today's bills. All right, picture this. You owe your friend 50 rupees, and it's due today. You check your pockets, you find 30 rupees. Then you remember you have another 20 in your piggy bank back home. Phew, you have exactly enough to cover what you owe right now. So that little story, it perfectly explains a tool called the current ratio. It's a simple question. Do you have enough cash and other stuff you can turn into cash quickly to cover your immediate bills? And here's the golden rule. If the ratio is 1 or more, you're in the safe zone. Anything less than 1, and you're in the danger zone. You're really risking it. Okay, so we've got a business that's profitable, and it can pay its bills. Great, but is it working smart, or is it kind of being lazy? This brings us to the efficiency check. Let's talk about all the stuff a business has to sell, its inventory. So imagine a toy shop. If those toys are just flying off the shelves, that's fantastic. That's money on the move. But what if those same toys are just sitting there for months collecting dust? Well, that's just money sleeping on the shelves. A smart business keeps its inventory moving. And look, it's not just about selling your stuff quickly. What about actually collecting the money? The receivables turnover ratio measures how fast a business gets paid by those customers who say, "I'll pay you later." And let me tell you, this is so important because a business that's slow to collect its cash can go under, even if it looks profitable on paper. Okay, let's zoom out a bit. We've looked at today, but what about the long term? Will this business survive tomorrow, next year, the year after that? This is the solvency check. Right, let's go back to that shop we were talking about. Imagine you started with 50 rupees of your own savings, but to really get it off the ground, you borrow 150 rupees from your uncle. Now, this relationship between your money and borrowed money is right at the heart of long-term survival. And that right there brings us to the debt-to-equity ratio. It measures how much a business is relying on borrowed money compared to its own. Now, a little bit of debt can be like fuel for growth, but too much creates a ton of pressure. I mean, if sales dip for even a month, you still have to pay your uncle back, right? Finding that perfect balance, that's the real key to surviving long-term. All right, we're at the last part of our checkup. After we've looked at profits, cash, efficiency, and debt, we have to ask the final question. If you wanted to buy this business, what is it actually worth? This is the valuation check. Let's wrap up with one last story. You find a neat little toy shop for sale. The owner wants 100 rupees for it. You do a little digging, and you find out that the shop makes a nice, steady profit of 10 rupees every single year. What you just figured out? That's exactly what the price to earnings, or PE ratio, tells you. You're paying 100 rupees for something that earns 10 rupees a year, so the PE ratio is 10. You're basically paying for 10 years of the shop's profits. Now, a higher PE often means people expect a lot of future growth. A lower one, well, it could be a bargain, or it could be a sign of trouble. Okay, so let's pull all of this together for the final diagnosis. We have seen that each type of ratio answers a really basic question. Profitability asks, am I making money? Liquidity asks, can I pay my bills today? Efficiency asks, am I working smart or just being lazy? Solvency asks, will I survive in the long run? And valuation asks, is this thing actually worth buying? If you only remember one thing from our checkup today, let it be this famous saying: revenue is vanity. Profit is sanity, but cash is reality. Big sales numbers, yeah, they look impressive. That's vanity. Profit is what actually keeps the business healthy. That's sanity. But having real cash in the bank, that's reality. That's what keeps it alive. So with just these few simple tools, you can now perform a pretty solid health checkup on almost any business you can think of. The numbers, the ratios, they don't lie. So the only question left is, who are you going to put to the test first?